Welcome everyone. This is the video for associates and joint ventures, which we will talk about a little bit. Again, you will need to see the link between the different study units here, and we will talk about it, making sure we understand exactly what we need to be able to acquire or be able to master. So this is for associates. So let's get started straight away with associates and joint ventures item. So if we think about our study unit, again, study chapter 11, we already now need to see that what we've done in the previous one or the previous section, we already covered at the end of the day all of this when we talk about subsidiaries. I'm going to repeat that, and then what we need to be able to do, we need to identify an associate or a joint venture, and we will talk about that, and then apply the equity method to account for associate, and we will get into what that is specifically. The main thing I need to see is investment in associates or joint ventures is set out, and we need to apply the equity to account for them in the consolidated financial statement. So we need to be able to identify and see that risk-free is still applicable because it's a business combination. So we will need to measure our assets and liabilities at acquisition date. Thereafter, we don't apply IFRS 3 anymore because there's no goodwill that we recognize, because we don't consolidate. We're not seen as one. So with the equity method, we need to see it's cost plus growth. So I need to make sure that I understand how that will work. And then there's also a link with IFRS 13, the fair value measurement. So we can measure our items fairly, or our investment in our associates at fair values, but then we need to reverse that to account for it in my separate financial statements. You will see that IFRS 13 links here as well. We've done a video about IFRS 13, about the different measures, and you can then make sure that you are able to understand how it fits into groups at the end. The main thing I need to see is, for an associate, I need to understand what is significant influence. I will get definitions of what significant influence and need to be able to apply. So this is a nice discussion type of question. And then the main thing, what we've done in that first video about the bird's eye view, you would have seen, we said 20% or more tells me that there's significant influence if I don't get anything from this definition, which I need to be able to apply. Then, if we go and see that there's significant influence, we apply the equity method. And the equity method, in short terms, means cost plus growth. Make sure that the equity method, you understand that it's cost plus growth. But here's the important part. At acquisition, if I paid more than what it's worth, so let's say, for instance, and just use a silly example, so let's say I acquired a 30% share in a company with their net assets being worth 1 million rand, and I paid now for them 350,000. If I use my 30% share, I would have seen that the percentage that I'm entitled to of their net assets is 300,000, but I paid 350. So there's a part that I paid more, which normally would have been goodwill, but in this case, goodwill is included in my cost, so I don't adjust for it any further. I don't recognize it separately. It's part of cost, and then I leave it. And here is the trick where we normally get caught out. So this is a catch, right? On the other hand, if I pay less, I still need to recognize a gain on bargain purchase for an associate. So make sure you understand this part. So let's use that same example. Net assets, 300 or 1 million rand. I acquire 30% share, but I pay 280,000 for it. And now I will see that there's 20,000 gain on bargain purchase. So at acquisition date, for the associate, I will always test for gain on bargain purchase. And if it happens, I will have a journal stating debit my investment, credit gain on bargain purchase, to make it more, to make sure that my investment is at least its percentage share what it's worth. And then I will recognize for growth thereafter. Make sure you understand that initial test for gain on bargain purchase. Then when we go and look at the things that we need to be able to account for, when we go and look at growth, anything that happens then subsequently, if I go through the information that when there's growth, we will need to see that anything that I have at the end gets accounted to at my investment. So you will see that they give me a bit of background here for IFRS 13. what do I need to recognize initially? So information about contingent liabilities and other things. So make sure you understand this, and this is also applicable for subsidiaries. So make the link with IFRS 13 to subsidiaries, the fair values that I need to recognize initially at acquisition date, which wasn't mentioned. So please make sure that you see that this first part of fair values for goodwill, etc., is applicable now for subsidiaries. Okay, and then I want you to make a small note over here for the associate saying what my equity plus or my cost plus growth means is the following. For the associates, we are on cost plus growth. And remember the principle we said, if I paid more, that's perfectly fine. It's still in cost. But if I paid less, I need to recognize a journal. So the first thing we do is the test for our gain bargain purchase. And this means then that there will be a journal where I go debit my investment in the associate and credit the gain on bargain purchase. And this is if it's in the current year through P&L. If it's the prior years, it already lies within retained earnings. And then thereafter, we account for growth. And the main thing I need to see is it all goes to in my investments. I will have debit my investment in the associate. And then there will be a lot of items that I credit. So all the growth of the prior years will go to retained earnings. And you'll see my aim here of my journals is to bring in the part as mine, because I'm not seen as one. The system does nothing. So because the system does nothing, I bring in the part that I'm entitled to. So it will be, in my example, the 30% of growth since acquisition date in retained earnings. And this can either be in a statement of financial position or a statement of change in equity. You can choose which one you use. Both of them is applicable. And then the current year's growth will go to credit, share, in profit, in associate through P&L. And this is the separate line items that I recognize. So here, remember in the bird's eye view, we said there's 3 items that we recognize in our consolidated financial statement. So in the statement of change in equity, we'll have retained earnings, the part that we're entitled to, which I've shown you now. Then in the statement of financial position, we only have our investment in our associate. And then in the statement of profit and loss, we only have one line item, share in profit in associate. And please make sure that you mention that the share in profit in associate is an after-tax amount already. So that is what we need to account for. And the last one that I might have is when they pay dividends. So I'm going to take out the dividends which the parent received. In profit and loss, eliminate that, reduce it because I'm not entitled to get my percentage share. I need to take it out, and it reverses then what I'm entitled to of my investment, so it makes the investment less. So all of this happens in one journal. Make sure you understand that part. And then there's intergroup transactions. And what's important here for you to know is because there's sales between the parent and the associate, can you see that I have all the items, all the assets, liabilities, income, and expenses of the parent in my consolidated financial statements? But for the associate, I only have investment in associate, retained earnings, and share in profit in associate. So this means if the parent makes an unrealized profit, I can affect all the items in their separate financial statements to take out the profit. But if the subsidiary makes the profit, I only have retained earnings and share in profit in associate, which I can affect. And that's important for me to note when I need to eliminate those intergroup transactions. And then on the other hand, if the parent made a profit and the associate sit with the asset, I don't have anything for that assets for inventory or PPE specifically. The only asset that I have in the consolidated financial statement for the associate, if the investments are, will affect the investment. So make sure about it. But on the other hand, if the associate made a sale, the parent has the inventory, the parent has the PPE, and I will then affect PPE. So make sure that you understand that concept. I hope this helps you. Have a nice day, and we'll see one shortly. Keep well. Cheers.